Hello, everyone. Welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets. I'm joined with my colleague, Victor, who is macro analyst. I'm more of a macro analyst than a technical analyst. Am I right in saying that, Victor?
That is correct. Hello from me.
Yeah, excellent. So I'm hoping you'll have some interesting thoughts about the upcoming FOMC meeting today, which
Sure.
we will get into in a minute or so. Obviously, this webinar is live, but if you're watching the recording of this on YouTube or elsewhere, please consider joining us live for the next one, as you will have the opportunity to ask us questions about any tradable markets with Think Markets. Make sure you like and share this. It will encourage us to provide more content like this. Okay, so for those of you who have joined us live, please help us by writing comments and questions in the chat box, and we will be more than happy to provide analysis on any particular market you're after. Before we proceed, please read through the risk warning, and I'm going to help you by reading the first paragraph. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Right. So you guys should all know about the agenda. Then I keep repeating this because just so you're not aware of it, we have this webinar happening every Tuesday at 11:30 London time, and Victor and I try to provide as much as a mixture of fundamentals and technicals as possible. But Victor does more of the fundamental analysis, and I do more of the technical. And we do have the a Q&A session at the end of the webinar. So the markets have come off their highs in recent days, but today the markets have rebounded. It's the same fundamental drivers pushing equities higher, which is optimism about vaccines, the pace of which has accelerated in the US and in the UK. But there's been some problems in the Eurozone, and I'm sure you guys all know about the AstraZeneca Oxford vaccinations, which have been halted in Germany, Italy, France, and a few other, or many other European countries, I should say. And that caused European indices on Monday to retreat a little bit, but they have bounced back because investors expect the vaccinations to resume because the blood clots happening in a number of patients is very small, and it's normal. So I think,
well, it's basically no different than your usual occurrence of thrombosis, as they say.
Yeah. So I think it was a bit of an overreaction from European countries, but hopefully they will resume the vaccinations, and hopefully in the not too distant future, European economies will come out of lockdown as well, and hopefully things will go back to normal in a few months' time. I don't know. I'm just being
on this note, I can say that this morning there was a note from Deutsche Bank, which who have downgraded European growth forecasts for this year and upgraded their UK and US forecasts. So the euro area has been downgraded to 4.6% versus 5.6% previously.
Okay.
And the US has been upgraded to 6.6% from 4%.
Yeah.
And the UK to 5.7% from 4.6%. So basically we're seeing these slow vaccinations in Europe already taking a toll on the expectations for European growth.
Yeah.
And at this point in time, I don't really maybe I'll wait a bit to jump into straight commentary on the euro dollar. But yeah.
Well, I think if anything, it should keep the pressure on the euro pound, because the dollar is acting quite. It's not the kind of logical response you would expect the dollar to be, behaving like. Okay, the dollar has come back it has come back against a number of foreign currencies in recent weeks, but over the last 12 months or so, it's been in a larger downtrend, and the euro has been able to rise because of a weakness, because of the weakness in the dollar, and because the euro is a more of a risk sensitive currency than the dollar is. So it's difficult to in my view to interpret what weakness in eurozone means on the euro dollar exchange rate. Logically, it should mean euro dollar being weaker, right? Because the
it's I think that the market is still way short the dollars.
Yeah,
way short dollars against pretty much every currency out there. Yeah. What I do see as a change of tone on part of emerging market central banks, for example, like maybe if you're shorting the dollar, I mean, if you're long the dollar against emerging markets currencies, be careful out there, because they will be the first to react more aggressively to interest rate, to inflation worries.
Exactly.
We are already seeing it in Turkey, and yesterday Russia announced that they're probably going to hike rates 125 basis points this year.
Okay, so basically, if they hike rates, are you suggesting that their currencies, the emerging market currencies, will strengthen against the dollar?
Yeah. Well, it already has happened to a tune.
Yes.
With the Russian ruble, for example, and with the Turkish lira.
Yeah, Turkish lira started to come down, rise against the dollar in November of last year, when the Turkish central bank made a Turkish government, I should say, made a U-turn on interest rates.
Yeah.
And allowed the central bank to hike interest rates, and appointed a new head of finance, etc. And that caused the Turkish lira to start rising from ashes, really. And it's finding renewed strength in the
rising. Well, if we're going, however, if we look at the major central banks, I mean, the G7 central banks, well, which one is going to be the first to hike rates? It's usually the Fed, guys.
Absolutely, yeah.
Every time, every cycle, the Fed moves first.
It's because the US economy is the world's largest, and it tends to outperform other major economies because of its size. I think that's why the Fed is always or tends to be the first mover. Maybe I'm wrong, I don't know, but I think that could be the reason why. But anyway, the Fed is going to meet today, not today, tomorrow on Wednesday. And that's going to be the most important macro event, arguably, this week. And everyone is watching that, will be watching that to see what the Fed can do to ease concerns about rising yields. Let me just get rid of this and show you. Show you the yield charts. Okay, so yields have risen across the board in the US. This is the 10-year. It's come down a little bit, but the trend, as you can see, has been bullish since the middle of last year. And same with the Eurozone yields. This is the German bonds. Easing back down a little bit, but the trend is bullish.
Well, yeah, the German bonds are still in negative territory.
Yeah. UK yields are on the rise.
Yeah. So you mentioned the Federal Reserve's meeting tomorrow, and what I can say on this is that we should be keeping a close track, close attention onto their updated forecasts for GDP growth and for inflation.
Yeah.
Well, according to their so-called dot plot, they're not pricing in any rate hikes through the end of 2023.
Yeah.
But some analysts have already said that it's unlikely that they'll wait that long, because if yields keep on rising, basically that means that inflation pressures are rising. So well, we need to see pre-pandemic yield levels first. So if you maybe move these charts to a weekly basis, so we can observe what used to be the yield on the 10-year before the pandemic. Yeah, well, I would say that we're quite safe below 2%. I mean, I don't believe the Fed starting to do anything with yields until we get to 2%. And then the other point is that, well, basically overdoing it on quantitative easing and yield curve control, or whatever you want to call it, it's going to pressure the dollar. I'm not sure that from a political standpoint, this is a step that the U.S. government is willing to take at this point in time. If they start basically controlling the yield curve as in Japan, that will be a disaster for the dollar. And one of the biggest assets of the U.S. economy, in my view, is the dollar's reserve currency status. So somehow I don't see the U.S. shooting itself in the foot by losing control of the dollar.
Yeah.
At least not at this point in time. Not when the markets are at all-time highs and everything is still rosy. It looks that way.
Interesting. So yield curve control is one option left for them later on in the year. But I honestly don't think that the Fed is going to do much at this meeting. And
no, not really.
And I think their hands are tied anyway. Yes, job, unemployment claims remain high, but employment has been improving and inflation is on the rise. Against this backdrop, you'd have to wonder, what can they do? Their mandate is to control inflation, keeping it stable around 2% average target, and keep employment near its potential. So with those two mandates in mind, the Fed, the U.S. economy is heading towards higher periods of inflation anyway. So the only concern for the Fed, I think, is maximum employment, which is still some distance away. But there's a trade-off, isn't it, between...
Especially if you look at the labor force participation rate, which is still way lower than it used to be before the pandemic started.
Yeah. I think another point is that the Fed has now the support of the U.S. Treasury, isn't it, and the White House, because they are providing lots of stimulus, from a fiscal point of view. So the Fed will be less inclined to act more, to do more in terms of monetary policy.
If anything, actually, the Fed has been always very vocal that there needs to be more fiscal response, and now we got this fiscal response. So what gives? Let's wait a bit. Let's see how it goes.
So against that backdrop, it's very likely that we will see the dot plots moving higher in favor of stronger economic performance, and the first rate hike expectations in the dot plots will be brought forward, in my view, and it's the speed at which the expectations will change that will ultimately determine the direction of the dollar. But It looks like the market is pricing in the Fed to be somewhat more hawkish than they have been. Hence, the dollar has gone up in recent weeks. And looking at transitioning to technical analysis now, and the dollar index is obviously one of the key measures of the dollar as a currency. Obviously, it's influenced greatly by the euro dollar, but nonetheless, this does provide a snapshot of how the US dollar is performing. And judging by the break above this shaded region on the chart and the break of the trend line, recently the dollar has been doing okay. It hasn't rallied very sharply. But it has started to print a higher high, a higher low here. It's broken resistance area here, which is now going to be a key support. In fact, this key support has already been tested on the 11th of March, 12th of March. And then it bounced from there a little bit. So
we
as
could
things
see
stand,
another test tomorrow into the Fed meeting. We'll see.
Possible.
I wouldn't rule it out.
No, we wouldn't rule anything out. And just because the trend has broken, it doesn't mean the downward trend just because the trend line has broken, it doesn't mean the trend for the dollar has ended, the downward trend. Indeed, the dollar is still below the 200-day moving average, which is a longer-term indication of the trend. And so long as it is below this trend moving average, you'd have to be a little bit careful and not jump into any conclusions based on a trend break or break of short-term resistance areas. Ultimately, if you zoom out, you can see the dollar is still printing lower lows and lower highs on larger time frames, but on the smaller time frames, if you zoom in this in the 3 months of this year so far, you can see that it's starting to show some bullish characteristics. So keep an eye on this key support area. If it holds, which is possible, then the next potential upside target could be 92.50, which was the previous high and where the 200-day moving average comes into play, just ahead of the 92.50 handle. And on the downside of the key support area at the 91.05 to 91.50 breaks conclusively, then that would potentially signal the resumption of the bearish trend. And in that case, then we could be talking about the prior lows once again. So a lot will depend on the FOMC. Don't forget, we also have the Bank of England and the Bank of Japan meetings this week as well. So those meetings could provide the pound and the yen direction as well. Now, we were talking about the euro dollar earlier, weren't we? And the euro dollar is still clinging on just about to the 200-day. It has come down from its recent peaks, but the weakness has been contained so far. And is that a fair way of drawing a channel? There was a bit of a fake out.
Yeah. Seems fair. I mean, a fake breakout followed by another move lower.
Yeah.
And now we're seeing previous support levels acting as resistance. Perhaps 120, the 120 area would be key, as it usually is.
Yeah.
Every time prices reach that level.
It's the area around 120, isn't it? It's not exact level, but it has deviated from 120 here and there, for example. The area around 120 is key.
So if we look at the traditional price moves, perhaps a break above the recent high around 119.90 is going to be a fake out in your terms.
A potential fake out
of your potential fake out in your educational videos. You have elaborated on what that is. So basically, the price flirts with a key level, breaks it, but doesn't really close above it, and proceeds to take out stops
So Victor is talking about the educational videos we've created on YouTube. If you go to YouTube, if you go to YouTube, hold on, Think Markets. If you go to our YouTube channel, we've created lots of educational content, and what Victor is referring to is the this playlist here, the Trading the Failure of Key Reversal Patterns. If you click on that, we have a number of videos here, as you can see, and the list is growing. We're adding more content to this. There's lots, I talk in great detail about fake outs. So if you're interested, please do watch those. Make sure you like and share them as well. You learn a lot. Just on a side note, to give you an example, the euro dollar it looked like it was going to break above this key resistance area on this particular day. And at one point, it looked quite bullish. There was a big breakout here. And that made me think, and probably other people as well, that the euro was going to climb and take out the previous high. It didn't. Look how it closed back down and below that breakout level on that particular day. And that fake out clearly indicated that there was a lack of demand from buyers above that level. Okay. Sensing that failure or that weakness, the bears took full control in the very next day, driving price down initially below this low, then below this low, and they still kind of remain in control of price action. So that was the key reversal day for the markets. So do watch out for such fake outs because they do provide strong indications about the direction of the trend, especially in the FX. So actually, it works on any tradable market, but there's a lot you can learn about that topic in the videos that I've created here, and they happen on all kind of key technical patterns like head and shoulders, double tops. There's candle patterns failures, there's trend break failures, etc., etc. So there's lots of content you can learn from this if you wish to learn. But yeah, carry on, Victor.
So overall, the fundamental picture remains favorable for the dollar, I would say. The projections tomorrow are going to be key. So watch out for those figures that the Fed announces, and the press conference of J. Powell after the Fed decision. And from there on out, we should see another leg higher if there is no change in the policy, I think.
Yeah. Talking about fake outs, there was one particular scenario here. If I move this line, see there was a high here, price moved above it but failed to hold, and that led to a massive move down. So that level is going to be key to keep an eye on now, because previously,
and we're already flirting with it.
Yeah, we've seen a very strong reaction from around that level, and look what happened yesterday. Price nearly got to that level and then started to head a little bit lower. This isn't obviously not a significant response, but what I'm trying to say is if we now get above that 109.40, 50 level, then it's also like an area of demand or supply rather, because this right here in this up move, that's where the previous selling started. So could we see some pressure come into the dollar yen in here ahead of the Fed? It's possible. But if we break through that, then the likely scenario is that rates will want to push higher towards the 2020 high because there's no further resistance from there on. Over to you, Victor.
Yeah, this pair seems a bit stretched to me. I mean, the Japanese yen has been the weakest in this run higher of the US dollar, and Perhaps if there was a pair about which I would be cautious, it's probably this one, because being a risk-off play, the Japanese yen could at any point in time just take a few figures back before resuming its downtrend. So be careful of. I'll be cautious of buying the dollar against the Japanese yen at these levels.
Yeah,
it has moved substantially lower since the start of 2021.
Yeah,
we have seen like what
seven handles.
Yeah,
700 pips.
Yeah. So at this point in time, I would be waiting for a pullback to get back into the trend move. Basically, that's what it is.
So there's two ways you can play this. Obviously, well, there's so many ways. You could wait for a pullback, as Victor mentioned, maybe somewhere around this particular area, if it gets there, because this is, if you can see here, it was resistance, and then a breakout, or maybe if that breaks, then the next level here. Obviously, you will need to see a bullish reversal there to consider longs, or alternatively, and one of the ways I like to get on board is, wait for this area of resistance to clear, and if price forms a structure there, then you could try to get on board around there, placing a stop loss just below the structure that it will have, or it may have formed there. And then your target could be towards the 2020 highs. There's lots of ways to get on board, obviously, on the long side. But if you want to get on board on the short side, perhaps a break of this low here, which was the most recent low prior to this latest up move, a break below there could potentially pave the way for a correction of some sort. So I wouldn't short it necessarily here because the trend is still bullish. But if it does show bearish characteristics and price creates a lower low, then at that point, if it breaks below these lows, then I would be more inclined to look for a short than around current levels. Yes, you will have missed a bit of a move, probably 100 pips there, but you will have some confirmation to work with, and the trend will have been in your favor once you have confirmation. Shall we talk about gold, Victor? Because
sure.
I'm sure a lot of people trade gold, and there'll be a lot of question marks about what will happen with gold. It's had a little bit of a recovery in recent times, following its sharp move lower, finding support from the trend line of this channel, bearish channel. Now it's kind of in the middle lower part of the channel, and it has printed a couple of interesting candles, but there's been very little follow through on the upside. For example, we had this hammer candle on Friday. On Monday, there was very little follow through to the upside. Today, it's very small ranges, which to me indicates a lack of desire from the bulls to step in, which doesn't surprise me, to be honest, because of the rising yields and ahead of the FOMC meeting.
We have spoken extensively about the risk play that gold is, basically a hedge against risks, and since most of the risk seems to be dissipating right now, and the biggest risk to the market seems to be higher yields, seems like a very unsupporting environment for gold prices, because first of all, we had the risk play, like meaning that we had all the uncertainty about the coronavirus and how we're going to handle this. That seems to be dissipating with the vaccines, albeit slowly but surely.
Yeah.
So the market is slowly but surely eating away at those gains marked last year.
Yeah. Yeah, indeed.
And from I ask you every time from a longer term perspective. If we look at the monthly charts for gold, they seem very, very bearish.
Yeah. Well, it does. Yeah. It's now kind of met its ABCD objective, or kind of met it at around the 38.2% February trace. You can see this more clearly on the weekly time frame. So basically, I've drawn a line from here to here. There's been A, there's been point B, and I've cloned this and attached it to this high, which gives us a projected point D at 1658-ish, 55. We didn't quite get there as rates bounced at the 38.2 February trace, but nonetheless, it's kind of reached close enough to the point D. So there is a bit of a technical bounce there, if you like, but the key area of resistance remains this shaded region between 1765 to 1800, which was previously support and resistance. So below that, we maintain a bearish view on gold. Crude oil prices have started to come down a little bit. We poked above the 2020 high, as you can see on this weekly chart. This is WTI. We poked above it a few days ago, and last week prices closed in the red, barely, but closed in the red nonetheless, and below the 2020 high. A potential bearish signal. And on the daily time frame, there hasn't been a significant to the downside.
Still barely moving away from the top, but if you want to wait for it to go lower to go short, I don't know.
Yeah.
We spoke about it last week. Basically, as it was making, it hasn't really changed. Prices haven't really they have hovered between 63 and 66 for most of the week, and we're still testing these recent highs, and we're still failing to break decidedly higher. So
with that in mind, if you are trading crude oil, I think trade it from one level to the next and move on until the trend becomes clear. But if someone had a gun in my head and said you have to trade crude oil and you have to pick a direction, I would short it, simply because it's risen so much that I don't think the fundamental support price at these levels. And also we have a potentially bearish signal here on the weekly time frame, which is a failure above the most recent high following a big up move. So it's bound to come to be hit by some profit taking. I don't know how long that will continue, but you should expect to see some profit taking, and we have seen some profit taking as it's gone down. Zooming into the hourly time frame, it's interesting to observe a few things. We had a high here, tried to stay above this high so many times, but it failed. See that? And if I zoom in here, first of all, let me tell you about this. We had a low here. Price broke that low. Okay, so there's a bit of a shift in market structure of higher highs and higher lows in the short term. Here we had created a high. Price tried to move above that high on several occasions, as you can see, but failed. So then what you do is you highlight the last low prior to the move up, which ultimately failed, which would have been this area here, right? If you move it across, you can see how price tested that level over here, and it starts to drift lower once again. So price is creating bearish, oil is creating bearish price action right now on the lower time frames. Be careful if you're bullish on oil and long, because I'm starting to see some bearish characteristics come in into play in terms of short-term price action. And I wouldn't be surprised if oil were to break down and go all the way to test this level. Why this level? Well, this is the point of origin of the big breakout that happened on the OPEC day, right? So that level was previously resistance. We broke above it. Price never came down to retest it. It got close enough here, but never came down. So there's a possibility that oil may come down, test this level, and then bounce from there. Or maybe it wouldn't bounce, I don't know. But that would be my downside target, around 62, 65-ish, if oil continues to go lower from here. If it breaks through this trend line, I think it will be game over for the sellers in the short term, because it will have moved back above that 2020 high and this supply zone here. So any decisive break above 66.50 would be bullish in my view. So yeah, around there, 66.40-ish is the invalidation of it for me. If I'm bearish on this, I don't want to see oil go back above this. If it does, then it means the long-term bullish trend has resumed. Okay, let's talk about indices, and then we'll wrap it up there. And let's see if we have any questions. There are a couple of you in this room. If you have any questions, guys, about any tradable market with Think Markets, please write it in the chat window or on the questions box, and we'll be more than happy to answer any questions you have. Okay, so let's move on to indices. Obviously, a lot of focus has been on the Nasdaq because of its because of the fact that the Nasdaq is a technology heavy index, a tech heavy index, and it has created a bullish signal in that it has broken this bearish trend line, but it's still lagging other indices like the S&P 500 here. S&P 500 has broken to a new record high. It's going to open at a new record high today if it stays around the same level. And this was the previous record high, this black line here. So we moved above that. So clearly the path of least resistance continues to remain to the upside for the S&P. Same for the Dow, I'd imagine. Yeah, big breakout after prices broke out, or the index rather broke from this continuation pattern to the upside. And FTSE is looking quite decent as well. Break above the triangle continuation pattern a few days ago, retested this, and then it's bounced. And now we're moving above this high. The next target would be liquidity resting above the recent highs if the trend continues. Same story with the German DAX index. It's broken above this area of resistance, moved higher, and it's kind of consolidating near the highs, which is bullish. So indices look quite bullish as things stand. Will the Fed change that on Wednesday? It remains to be seen. If the Fed does signal that it will be moving towards tapering of QE in the near future, that could unnerve investors and cause the markets to sell off. So that's the key risk facing the markets on Wednesday. But that aside, ongoing optimism, the record or the second record stimulus from the government in the US, $1.9 trillion worth of stimulus coming into the pockets of US citizens. Some of that money is finding itself into the markets and into cryptos for that matter, which has continued to fuel this ongoing rally. However, yields are on the rise, and as we mentioned earlier, keep an eye on this, because if the pace of the rally in yields accelerate, especially after the FOMC statement tomorrow or the press conference, then that could unnerve investors in the equity markets. But this will also be bad news for gold if it continues to push higher, and potentially good news for the dollar. So, do you have anything else to add, Victor?
No, the equity markets seem to be rather constructive at this point in time. Yeah. So I mostly like we have been hearing over recent weeks and months really how valuations are so stretched and so on and so forth. However,
none of that matters right now, does it?
Yeah, until interest rates are relatively low, this doesn't matter that much.
Yeah, which is really a shame if you think about the markets being fairly priced and etc. Markets being efficient. I wasted a number of years.
Hypothesis is only a hypothesis.
Yeah,
if you
I wasted a number of years studying that hypothesis during my uni days. Yeah, doesn't really work in real life. But yeah, so that's the markets for you. They can remain irrational longer than you and I can remain rational as one.
And solvent.
That's it. Investor once said. Anyway, with that, let's end the webinar. Thank you so much for attending, guys. I hope you have a wonderful week ahead. Please be careful out there. The Fed is meeting on Wednesday. We do have the Bank of England and Bank of Japan later in the week, and a few market moving data as well. We have, for example, employment data from Australia and a number of other things to keep traders, FX traders, busy. So be careful and try to make the most of it. If you have any questions, please don't hesitate to get in touch with us. You can get in touch with me via Twitter, and I'll be more than happy to answer any questions you have in the meantime. But
stay safe out there.
Yeah.
And buy low and sell high.
Or buy high and sell even higher in the case of the stock markets. Yeah, that's not financial advice. All right, take care. Bye-bye. See you next time.
Cheers.